So there was a time a couple of years ago where I've already been trading options. I'm already pretty consistent. I've already had, my fair share of losses the first couple of years that I started before I found a mentor and a community, which for me was the biggest thing that truly helped my development, was actually getting with someone who's been doing it for a long time. They were very consistent already. They've been in the game over 10 years, over 15 years, and really helped kind of progress me along from doing things that maybe I thought at the time were the right things to do, but necessarily weren't the right things, right? So I kind of figured that out. And there was a point in time a couple of years ago where I heard about prop firms, okay? And I thought, well, I've already been trading options. I already watched the triple Qs, which is the NASDAQ 100 index. I kind of had a look at the NQ futures all the time anyways to kind of correlate with a lot of my options plays because I normally trade, predominantly all of the stocks, not all of them, but the major big stocks in the NASDAQ 100, like Tesla, AMD, Apple, Meta, so forth and so forth. And there was a time where when I was looking at the charts, I was looking at the spreads, I was looking at the movement, I was looking at the liquidity, and I thought that this is a perfect opportunity for me to kind of double my income or add a secondary income. But I thought to myself, I don't really want to go put my personal hard-earned capital in there. I've kind of done some research. I've found some prop firms. Some of the first prop firms that I found was Top Step. That was the very first one. I also found Apex. I found a couple of others, some of them that were more focused on Forex. So I thought to myself, let me go ahead and sign up with a prop firm. I signed up for a $50,000 account. I'm already consistent. I already know I have a strategy. I have an edge. And literally within the first 2 days, I lost $50,000. Now, not literally, right? Not literally. I lost a $50,000 account in 2 days. For one, I had no idea about the lot sizes and the movement of the NQ. So automatically, if they told me I could trade 5 contracts, I jumped in with 5 contracts and was immediately stopped out on the day. I thought to myself, I'm very consistent already in making a full-time living and in doing this as a career already, meaning trading options, right? This is how I eat. This is how I pay my mortgage and my bills. I couldn't figure out what exactly I was doing wrong, right? Now, you may be at this point now where maybe you've had a little bit of success, but maybe you don't have a lot of money, or maybe, the idea of getting funded and being, a funded trader, trading other capital, someone else's capital is exciting to you, but you just can't seem to get over the hump. You keep blowing accounts. So a lot of people blow accounts. Now, in the very beginning, I kept thinking to myself, because I blew up like 2, 3, 4, 5 accounts. This is like 2 years ago. And I just kept blowing up accounts and losing more accounts and losing more accounts. And I couldn't necessarily figure out what I was doing wrong, because on the option side of things, I was already very successful and very profitable. However, when I came over to the future side of things and started working with the prop firms, I was not successful. So it was creating a little bit of a mental roadblock, because there's one side of me in my trading career where I felt very confident and very good about the way that I traded. And there was a whole nother side of my trading, which was the futures and trading for prop firms, that completely had a lack of confidence. So I was missing trades. I was holding trades for too long. I was revenge trading. I was blowing up accounts after accounts after accounts. And it wasn't until a time where I realized if this was real money, and I did load up, let's say $50,000 into account, I would have lost, because at that time, I think I had blown up like 5 or 6 accounts. I would have lost $10,000 to $12,000 in around 2 weeks' time. And I started looking at this, and I started really thinking to myself, losing that much capital in a matter of 2 weeks' time, if it was my own money, for example, $50,000 into a personal brokerage, I would have just given up around 15, 20, 25% of my entire portfolio, of my entire balance in 2 weeks. That's not the smart way to trade. So what I started to do from there, and what really kickstarted me to understanding the way that prop firms work, is that I understand that they're out to prey on new traders who don't know what they're doing, and they want you to blow up your accounts. They want you to keep paying for resets, and they want you to keep adding accounts and keep re-signing up and re-signing up. They don't really want to pay you. Now, again, if you are really good and you show a good track record, they will definitely move you into a live account. They will definitely put you on the A-book side, this, that, and the other, but there's a long process and a long journey to kind of get there. So when I started to really understand that it wasn't me, or it wasn't necessarily my strategy that was the problem, it was me trying to rush to get over to the funded side of things from the evaluation process, that was causing me to take trades that necessarily weren't there. So I was forcing trades. I was over leveraging myself. I was playing with too big a size for the movement on the NASDAQ. I had to take a step back, look at the higher time frames, reevaluate my strategy, which worked on the option side of things, and then from there, break down the equation to be able to withstand the drawdowns. Because sometimes in options, and sometimes in the futures as well, but sometimes in options, I'm able to take a play within the first 30 minutes to an hour, 10 contracts, 15 contracts sometimes. And sometimes I'll be playing things like Tesla or Nvidia. They'll jump up $1, $2, $3 extremely quickly, sometimes 3, 4, 5 minutes, sometimes even a minute. And I'm able to get in on those options contracts, 10, 15 of them, and actually, take out $500, $1,000, $1,500 very quickly. Now, I was noticing on the future side of things, because of the volatility, and because of the range, I wasn't necessarily able to go big size like that on a $50,000 account. Okay. And this is the reason why I kept losing $50,000. And that's the title of this video. How I lost $50,000, right? So I didn't really lose $50,000, but I kept on losing $50,000 valuations, which technically on Top Step, the drawdown was 2,000, and on Apex, the drawdown was 2,500. And I blew a matter of 5, 6, or 7 of these accounts in the first 2 weeks, just trying to get my feet wet and trying to understand what was going on. It wasn't until I started to size down and take a longer term kind of approach to trading these prop firms, which was when things started to click. When I started to understand the volatility, I started to understand the range on a 5-minute time frame. A lot of times, traders, they pick a time frame because they heard someone else trades it, and they have no idea what the ATR is, the average true range on each of those candlesticks. Now, sometimes on a 5-minute candlestick, the average true range on a NQ contract can be anywhere between 20 and 35 points. So if you're trading multiple mini contracts, the NQ, they're not giving you, the prop firms is what I'm saying, they're not giving you enough drawdown to be able to withstand that amount of volatility, which is perfect business for them and very bad for the trader. So the trader has to be able to adapt and evolve and be able to have a strategy that's going to give them entries, but also give them enough leeway to be able to withstand those high volatility moves. Now, again, the thing that happens with a lot of futures traders is that they do over leverage themselves, and they do catch those winning trades where they're able to make $300, $500, $1,000, $2,000 a trade. And what that does is give them a false sense of security and confidence to where they think they can do that all the time. And it just takes one trade for you to blow another $50,000 evaluation. It just takes one trade for you to give back a week's worth of gains and get kicked off the platform when you're funded. So by sizing down, by playing micro contracts, allows you to kind of manipulate the system into your favor. Because remember, trading is all about having an edge. And without the edge, you're pretty much just dead in the water, right? So your edge when it comes to playing these prop firms is to definitely take your time and not rush. Instead of trying to pass a prop firm in 7 days, in 1 week, in 2 days, take 30 days. Instead of trying to pass it in 30 days, if you have a little bit of a slower approach and maybe a 1-to-1 kind of take profit for a higher strike rate, take 60 days. because the whole idea and the whole goal is to get funded and continue to grow and pad that account. Now, every single day is not going to be great. Some days are going to be a little bit worse than others. Some days are going to be a little bit better than others. So as a trader, you need to be able to withstand the ups and the downs so that you can catch the wave when the market does start to heat up. So the moral of this story is, because I know you're out there and I know you've been going through the same kind of problems, stop losing multiple $50,000 accounts. Actually put yourself in the shoes of, what if you personally loaded up $50,000 into account? How many times have you blown up that account at a $2,000 or $3,000 drawdown limit and had to reset or buy a new evaluation? Have you had to buy more than 10 resets? Have you had to restart an evaluation more than 10 times? Well, the drawdown is between $2,000 and $3,000 on a 50K account. And if you've lost more than 10 of those accounts, technically you've lost over $30,000. Now, I was talking to a trader who said that they were on their 60th account. They've been funded, they fail, they blow up, they buy another one. And I started to do the math and I said, if you realistically look at it, they were buying $50,000 accounts with a $2,000 drawdown. They've bought over 60 accounts. 60 times 2 is 120. And they've done this within the last 6 months. So technically, they've lost over $120,000 in the past 6 months. Would you say that that's a good business practice? Or would you say that you need to maybe look at it a little bit more realistic and think about the 2,000 or 3,000 or 4,500 drawdown, whatever your drawdown is, depending on your account size? Look at that as your trading account and try to manage profits on that amount versus the 50,000 or the 100,000 or $150,000 combine. So again, I'm trying to save you and protect you from blowing and losing 50,000 after 50,000 after 50,000, because although you may think that you're just losing a demo account and you don't really have the 50,000, it's not like you had 50,000 in there. Some of you have blown over 20, 30, 40, 50, 60 accounts. And if you do the math times your total drawdown of 2,000, 3,000, you've lost well over $50,000, $60,000, $70,000 this year. That's why I started Evolution Traders, to help traders understand the mindset behind what it really takes to be successful, to actually teach them how to withstand the drawdowns, to trade live with traders each and every single day. If you guys want to take advantage, I have 3 spots open in my mentorship community. That link is down in the description box below, and I'll see all of you guys on the next one.